So I just had an interesting meeting with a local client here in Saskatoon who is selling his farm, and they're really excited, although really anxious about, you know, what lies ahead. And what their consideration was should we actually just hold on to our land and live off of the income that is derived off of, you know, leasing that asset. And what they failed to understand was that the future return of a certain asset class, like land, has the, you know, real good probability of being lower given the prices that where farmland are today among the prairies versus other asset classes. And I'm not here to say that farmland isn't a good investment or anything like that, but what it made me understand was that investors tend to really miss the mark on understanding that any time that you buy an investment, the price that you pay affects the probability of future cash flows and future returns. So what that means is that if you think about buying equities back in the third week of March, so you bought the stock market index, or you bought even just a basket of stocks or an ETF, and you were going into the stock market, well, your future returns going forward were a lot greater the third week of March than they are today. And I'm not saying that I know the direction of the market. That's not what this is about. Whereas conversely, when you consider, say, long-term U.S. Treasuries, gold, farmland, real estate, different things, because those assets are so inflated relative to where they usually sit from a cash flow perspective, the future returns suggest that they will be lower. Now, yes, gold could go up $300-400 an ounce as well. But if you think about the probability of that asset class, such as gold, having a strong return over the next decade, the higher that an asset goes up in value, the lower the future probable returns will be. And so you have to always be conscious and careful of understanding what the probable future returns will be when selecting an asset allocation. And that doesn't mean abandoning your true diversification, but you don't want to overweight or go heavier into asset classes that are inflated because of those future probable returns. Nobody wants to invest in something that's expensive, that has lower return projections, and yet, as hard as it might be, you have to give in and be favorable towards lower priced assets with a higher future return probability.